many years. So that is first and the most important aspect that we look for. Second important aspect that actually we would look for is really about quality of management and also about quality of business. I mean, for many this may look to be a jargonistic buzzword, but for us this plays a very important role. We would not like to dilute quality of management for the valuation that we are paying for. Because what happens is generally in markets, people tend to think that you can dilute quality of management if you are getting a business at a relatively lower valuation. But for us, we believe that when we buy high quality business, even though it may be available at a fair price, that is a much superior proposition as compared to a business which is of an average variety but may be available at great prices. We actually would prefer the former one. So which is why quality of management actually plays a very important role. Coming to quality of business, what we look for is, I mean, at the end of the day, it's what is the ROC of the business, right? ROC may just be a final word, but actually this ROC, if company has been able to show a pretty superior ROC across varied business environment, it essentially shows that this business has built certain economic advantages, certain moat, which cannot be copied very easily. This moat actually can vary from industry to industry. In few industries, it can be a distribution advantage. In few industries, it can be brand. While brand is something that is not necessarily a moat, it is an outcome of things that they have done, right? But few industries, it could be a network effect. In few industries, there are so many things which actually qualifies as moat. So essentially what we look for is large opportunity size in a business or in a opportunity wherein it's run by high quality management and characteristic of a business which is very powerful. So these are things that we essentially look for in any business when we look for the opportunity.
So to sum it up, it basically means that how fast a sector or opportunity is growing within the economy, and within that which entrepreneur is dynamic enough to take advantage of that, and within that you're looking at what is the capital employed or returns on capital employed for that entrepreneur. Is that the way to look at it?
Apart from this, I would also look at, while growth is vital, longevity of this growth plays a very important role. A one-time or a short spurt of growth may not be a great one, but a long period, sustained, slightly higher than, let's say, 15 to 18 or 20% growth is a much superior proposition. If a company can deliver 15 to 20% growth for 10 years, it can be a superior proposition than for a company which is delivering 25% growth, but we don't know for how long or for a very short period of time. So we look for this longevity of growth apart from the factors that you talked about.
How do you look at opportunity as well? Because within the opportunity you have domestic opportunity, which is, you mentioned, gave an example of air conditioners there.
Correct.
But you also have overseas geographical opportunities, how you expand into the geographical market. How do you bifurcate and decide on it?
See, for us, management should have capability to harness the opportunity that it is catering to. Over period, we have seen management's ability to cater to global markets has also evolved. In many cases, we are seeing Indian manufacturing capability being improved pretty dramatically. Right? Their products, even if they are not best in class or not necessarily best, but they are very close to best, right? So to that extent, India's manufacturing has evolved. So a company which can cater to the large market globally is also somebody whom we would really focus on. In fact, I believe time has come where manufacturing in India for the country and for the world actually will be a significantly bigger proposition, and government also is trying to play its part by kind of giving an ecosystem which will allow them to be significantly bigger tomorrow. So essentially it boils down to how are you defining your opportunity size. Domestic is one that can be more sustained, more secular, but somebody who can cater to a large global market and that market has capability to grow, right, is again a very important aspect.
So within the opportunity, when you look at entrepreneurs and companies there, we have seen some of the companies who have large market share and we've been able to maintain that growth momentum of 10-15% every year.
Correct.
And when such a company maintains that growth, you start giving them a higher multiple or higher valuation there. And because you say that there's a big runway, you are willing to bet on that high valuation and go forward on it, right?
Correct, that is right. So, growth in isolation is not enough. Growth backed by capital efficiency, which will allow them to deliver a far superior cash flow compounding, will allow them to get a superior valuation. Right? So that is what we actually would look for.
Can you give us an example? What kind of capital efficiency that you look at for a company, an average, any sector, if you can take it?
So generally we would build portfolios. The average ROC of our portfolio companies, generally you would see them to be more than 30%. Right? But that's what we have at the current point in time. But in general, the capital or ROCE for portfolio companies has to be at least 20% plus. Right? If a business can deliver that kind of ROCE, it effectively means that that company can grow at least at that rate without coming to markets. That also plays a very important role. A low ROCE company but has very high aspiration level actually is dependent on market vagaries for growth, and markets may not be very supportive at all points in time. Today, people are ready to give money for growth, but that may not be scenario at all points, right? So existing growth, high growth has to be backed by solid capital efficiency, and that is what is very vital.
How do you manage that? I can understand for a mature business, you have good cash flows and it's taking care of its own growth and capital requirement. For small and mid-cap companies who want to, go to the next stage, they would have to depend on either equity capital or a debt capital to expand. In that sense, how do you look at their debt capital or equity debt equity ratios, how they manage it, and how cash flows? Because in the initial phases, the debt equity would be much higher,
Correct.
And as cash flows improve, that's how it moves to that trajectory which it is there. So do you bet a company at that stage, or you only come in once they start into a mature phase?
So into businesses which are more developing, you will certainly see, or in many cases, more often than not, you will see ROCs to be way lower than, because businesses are actually investing for growth. Right? If we are able to understand what is the unit economics, what kind of ROC over period when they achieve size would that business able to generate, right? Those are businesses that we would focus on, even if that ROC today is under construction. That ROC today may be relatively suboptimal as compared to what it is going to be at a later point in time. So in those businesses, it's vital we understand network effect. We understand what will lead to that high ROC over period, right? Only those. So in businesses where we are not clear of how unit economics will play out, those are businesses that we'll stay away from.
And what is the kind of red flags that you look at when you look at these companies? Because many companies will have good ROC, capital efficiency, but there may be red flags as well. So is there red flags that you clearly look at when you look at investing in these companies?
So you're talking about businesses which are more mature?
Yes.
So in those kind of businesses, it's vital that we look at the agility, we look at focus of the management. See, this is an industry where changes will keep happening, right? Those businesses, those entrepreneurs where the kind of ability to be ahead of the competition, it's very important, right? If entrepreneur kind of mess up there, then it actually becomes very difficult to recoup. So when we are buying growth businesses, we are paying those valuations for certain level of growth, long period that they can deliver. If those expectations are not being met, we actually suffer. So it's vital we really keep seeing that, is this management focused enough? Is this management thinking into the business from a long-term perspective? Is this management ready to do things which are not necessarily earnings accretive today, but actually will lead to far better future tomorrow? So those are things which are very vital. And also we look at how many businesses management is kind of doing at the current point in time. Is he building sufficient level of bandwidth? Because those who are trying to do multiple things actually tend to kind of get impacted in few or one or two different businesses, right? And at that point in time, it gets really difficult to focus on even areas which are kind of growing well for them, right? And we tend to see that those businesses start to suffer, right? So we like to buy businesses where managements are focused. There is a significant alignment of interest, right? And which is why it's vital that we kind of don't steer away from this kind of management.
Sumit, hang on. We'll discuss about some of the sectors and themes that you've been investing through your portfolio schemes. That's after this short break. Welcome back. You're watching Portfolio Manager, and with me is Sumit Jain of ASK Investment Managers, who manages roughly 36,000 crores in equity asset under management. Sumit, we spoke about what you look at, during investing. Now let's look at where you've invested. What is the themes that you look at? Can you give us an idea of how do you look at the themes, and which are the themes where you're overweight as of today?
Sure. Let me first tell you, see, India is a country where opportunities are humongous. We may be invested in few opportunities, but that by no means would cater to all the opportunity that would be there in the market. But let me still attempt onto that as to what are the few opportunities that we are kind of finding it pretty interesting. See, we really believe that manufacturing in India for the country and for the world is a pretty large theme. In fact, this is an area where We have been at it. There have been a lot of false starts in the past, but now it looks like that we are at a point where this will be significantly larger tomorrow. See, there have been many steps that have been taken place, and when manufacturing starts to do well, you start to see the entire ecosystem getting better. So when manufacturing does well, you see capital goods businesses doing well. You see a lot of contracting businesses doing well. You see consumable businesses doing well, logistics doing well, staffing businesses doing well. So this is one area where we believe we have started to get into a virtuous cycle, and this cycle is just starting. Second area which has been running in, or which has been doing well in the country for a while, and I believe given India's own demographic profile, young population, income levels increasing, and over a long period we'll continue to see pretty decent growth, is about the premium consumption, discretionary consumption. Businesses where there is a D2C, where is a distribution that these businesses have built, which can't be copied very easily, and actually cater to young population where there is aspiration. I think many of those businesses actually will start to do really well. Even the consumption pattern of Indian consumers are changing. We are seeing travel tourism to become a significantly larger opportunity, right? So experiences actually is becoming a very, very larger theme. So I would say manufacturing in India, premium consumption, discretionary consumption, even healthcare ecosystem in India is actually seeing huge changes. We have pretty limited development on the infrastructure side, whether we call it as hospitals or we call it as diagnostic businesses, right? Those are kind of seeing a lot more opportunities. So, and when healthcare does well, even insurance part of the healthcare actually will start to do well. So I would say multiple opportunities, but we are still overweight on overall premium consumption, manufacturing. We have a decent exposure towards financial businesses. Financial again is a very large opportunity. Today our overall credit is about 50% of GDP. This is way low as when we look at many other large markets in the world. Over period, as our nominal GDP keep growing, really believe that credit growth will continue to run at a rate faster than our growth in nominal GDP. A high quality lending institution who understands their customer really well, who can control their gross NPA and yet can get a decent ROE. I think those are businesses that we would continue to bet on.
Within manufacturing, interesting, you spoke about capital goods, logistics, consumables. Do you see this capital goods cycle now picking up, kind of order books which have come in for many of the key big ones? Within capital goods, do you look, is defense part of that? How do you consider defense to be part of that capital good order cycle which is there? How do you look at these kind of companies? Is it a multi-year cycle for order books for them?
So, see, capital goods has always been a cyclical industry in the past. Right now, we are seeing cycle to be really favorable. While there can be some slowdown in order inflow given the fact that we are approaching elections, but longer term, if manufacturing...
But many of them are setting multi-year revenues in order book already.
That is right. So we have a fairly decent visibility on the capital goods businesses, and over period, as manufacturing starts to get significantly bigger, capital goods cycle will continue to be a bigger beneficiary or a very large beneficiary of the entire space. So we would not like to focus on a very short-term order inflow growth, but we are pretty confident that order inflow will be significantly bigger tomorrow as compared to what they are today.
And what about logistics and consumables you mentioned?
Yes.
We've seen a couple of logistics companies listed in the listed space, but not many are profitable in that sense, right? Cash flows are not that much. Do you see that there's a long runway for them and eventually becoming a large size logistics services provider?
See, in India, logistics is a pretty large industry already. But the problem here is many of the businesses are still unorganized.
Yes.
We will see many of these businesses actually be a significantly bigger beneficiary of this shift from unorganized to organized, right? And that coupled with a higher manufacturing ecosystem would mean that logistic actually becomes a significantly bigger opportunity. And logistic is actually very integral to any manufacturing piece for any country. So it is something that is an enabler for overall growth in the country.
You spoke about discretionary consumption, and within that you spoke about the network effect. Give us an understanding of what you mean by network effect and how does it play out for you in companies actually.
So while not exactly example of network effect, but if you look at aviation industry, right, that is a industry where probably roughly about two players actually will be kind of having a significantly larger market share, right? Industry itself is growing. Supply of aircrafts is a challenge. Cost of doing business is only getting bigger, right? So over period, we will see not only demand be significantly larger, profitability will also be significantly bigger, right? Entry barriers are becoming significantly larger because these industries or these companies actually have a significantly deeper penetration, right? And their ability to cater to the larger network is actually really high, right? So those are businesses where network effect is actually also helping them.
So you're basically seeing economies of scale that comes into
Correct.
play. So in the discretionary space, we have jewelry business or studded jewelry business kind of businesses which are high end. And high end of the K cycle, it's something that which will be, which will continue as aspirations go, come into play, basically, right?
So see, clearly, as we start to see premium consumption growing, right, we already are seeing how within consumption basket as well, even at the current point in time, as people like to call it as K-shaped recovery, right, wherein premium part actually is doing better than overall staple part or overall value part, right. Jewelry clearly fits in there.
Consumer electricals?
Consumer electricals as well over period will do really well. Premium consumer durables actually will also start to do really well. If you look at in a way, auto sales as well. You are seeing premium vehicles actually growing
SUVs,
actually faster than
is more
that is
faster
right.
than,
That's right.
but not the tractors because there is a slowdown in the rural side. So where is how do you look at sectors which are underperforming and may underperform for the near term or medium term?
So see, at the current juncture, rural may not be doing really well, but we believe that it's only matter of time. While we may not have seen very high growth in tractor industry in general can't grow really fast. Having said that, as we start to see inflation not being a significantly bigger impact, we will start to see rural starting to do well, right? So that is one area where I will not be worried. We really believe that over period, rural will bounce back because the entire ecosystem which is actually developing will benefit multiple players, and India actually will see inclusive growth rather than growth being driven largely from the urban centers. We are more focused on domestic businesses in our portfolio as compared to overall how international businesses are doing. In international area, you need to fight how global economies are also playing out, right? So global vagaries start to have bearing on their overall growth rates.
So you will underperform, underweight IT for that matter?
So we are underweight IT at the current point in time. In fact, we would be focused on businesses which are very niche in IT, businesses wherein we can see relatively faster rate of growth. Otherwise, in general, IT industry should not grow at a very rapid pace. So we are underweight there. We are also underweight global commodities. Those get impacted too sharply by how demand and supply side kind of plays out.
You mentioned briefly about financials. Within the financials, you have the private banks, public banks, and then you have the NBFCs.
Correct.
How do you play out these and in your portfolio?
So I would think opportunity is large. We are still 50%, as I talked about, of our overall GDP in terms of credit. So as this large opportunity becomes significantly larger tomorrow, there is opportunity for each of the participants. What we would look for is ability of the management to control their gross NPA and yet deliver on to ROE, right? And also at least grow faster than the industry. If these three things are met, then we would not be worried of whether it is owned by a public sector entity or it is owned by private banks or NBFCs as well.
Sumit Jain, it was a pleasure talking to you on the portfolio manager. Thank you for watching today. That was Sumit Jain of ASK Investment Manager, who manages nearly 36,000 crores in asset under management.